ultimately, what allows us as human beings, as people who have, come from some form of education, what allows us to be able to determine the answer here is not because we're intelligent, okay? It's because we have got key identifiers on which to lean on and therefore determine the pattern. Right? So very equally, or very easily, we can see there's a common consistency throughout all 5 blocks, and that's a circle. Right? So straight away, our brains tell us, well, there's a common consistency, therefore, we know for a fact there's going to be a circle. Right? We then have colors, so we can see that we have a white, and a black. So straight away, we can associate that, well, there's a very high likelihood that we're going to see a white block in the next one. Right? And the last one, obviously, we can see shapes. So we can see triangles and squares. Now, these shapes and colors and consistencies are nothing more than identifiers. Right? Now, if you can learn to apply identifiers to the way that you look at the market, guess what? Just like you can determine, what the answer to this question is, you are going to start recognizing patterns in the market. Now, a common mistake I see so many traders make is they never apply these identifiers. Rather, what they do is they try and go look at the market every day and find, 1,001 different patterns that most of the time don't actually exist. Right? In order to develop and recognize a pattern, you have to put down certain identifiers. Now, what are some of the identifiers you can use? And I'm going to show these to you in a practical example in a minute. So first and foremost is time. Okay, time is a wonderful identifier because it's consistent. You then have volume. Right? Again, volume is a wonderful identifier because we can see relative changes in volume. Moving averages are wonderful identifiers. The range is a wonderful identifier. Standard deviations are wonderful identifiers, and so are trend lines, and so forth, and so forth, and so forth. Now, the important thing is to ensure that you apply these identifiers consistently all the time. That will aid you in developing a pattern. Let's look at it. Let's take an example now and see how you can apply some of these identifiers. Now, again, guys, it doesn't matter what time frame you're doing this on. It doesn't matter what market you're doing it on. It doesn't matter. The important thing is you determine an identifier, something that makes sense to you. And then you go and look at the market based on that identifier, and you will start to recognize patterns that not just exist, on that day, but over a period of time and across many markets. All right. Now, here's an example. What you've got in front of you is the E-mini S&Ps. Most of you do trade this, so you will recognize this. Now, what I've got is a 5-minute time frame. You can see in the bottom here, I've got volume, and in the top, I've just got basic 5-minute candles. Okay, so I've used this example to keep it nice and simple. So the first identifier I want to outline is time. All right, now, what you should straight away be able to see and notice as a pattern, if you go over time, is that every single day around 2:30 p.m. in the afternoon, suddenly we get a very big pickup in volume as well as more aggressive shifts in price. Okay, so if we were to confirm and go back in the day, you will see in the overnight session when the pits are closed, the S&P 500 doesn't have a great deal of volatility or volume. And that picks up suddenly at 2:30. Now, it's obvious that the market opens at 2:30, but what isn't necessarily obvious is this pattern that exists where range and volume and volatility pick up around 2:30. So what we can do with time is we can go and break it down. So we can see that, over certain periods of the day, again in and around the close, we can see a real pickup in volatility as well as a pickup in volume. Okay, now we can apply this. We can go and say, okay, let's go and look at the day and let's see where the biggest moves came over the course of the day, or the most directional moves. And what we do is we apply a time to it. All right, so we put a bar here and we put a nice little bar here. Okay, and we can say that between the hour of 5 o'clock and 7 o'clock, on this day, we are seeing this kind of movement. Now, all of a sudden, if you start breaking down the way you look at the market in terms of this identifier, you're going to recognize patterns that exist based on various times. Right? This is what Edge is all about, guys. It's about learning to identify various patterns that exist based on an identifier. Now, it doesn't just have to be time. Right? What most professional traders do is they combine a multiple of all these identifiers. In other words, time plus volume, maybe moving averages, volatility expansion, and all of them together create unique, strong patterns. Okay, so our second identifier, as we've been speaking about, is volume. All right, so what I like to do is I like to tend to keep various volume levels on my chart. So what I would do is every single day I would go identify, what is relatively high volume, relatively medium volume, and low volume. So I like to use colors a lot. So I would tend to create a nice little, horizontal line here, and I'll create a nice little green bar. And green means to me that, good to go, or there's activity, there's business in the market. Whereas on the other side of the spectrum, where we have relatively low volume, I would have, say, a red line, which means to me low volume, cautious, lack of business going on. Okay, so I use volume in this sense to guide me when there's high volume in the market and when there's low volume in the market. Okay, so this is another identifier you can use. And again, what you want to go and look at is how does the market respond in terms of price when there's high volume versus how does the market respond when there's low volume. Again, you are going to start recognizing certain patterns that exist with high volume and low volume. The next identifier, okay, which is one that a lot of you like to use, is a moving average. Now, again, moving averages can be extremely wonderful, and they can provide us with wonderful information. So how do we use this as an identifier? Well, again, what I like to use is when a moving average is moving sideways, right, that's telling me that there's a real lack of, price direction or aggressive price direction. In this instance, I'm happy to not be aggressive in the market. So I wouldn't be looking to short aggressively or buy aggressively. Now, there's a number of different strategies you can develop. I know a lot of people talk about moving average crossovers, okay? But what I like to see is when we get a nice pickup in volume at a specific time of day and the moving average starts to be hugged, or the price starts to hug the moving average, I like to then not fade the market, but more importantly get on the trend with the market. Okay, so I've recognized that at certain times of the day in a market when the volume picks up, the price tends to hug onto the moving average and create a certain pattern. Okay, now the next one we can use, and again a wonderful tool to use, is Bollinger Bands. Now this gives us obviously recognition of volatility, so how price is moving around the average, or how we're moving around the how we're variating or variance around the mean. And as we can see that again we can see when the Bollinger Bands are tight, we can see that price moves in a specific way, volume moves in a specific way. We can then see at certain times that the Bollinger Bands expand as well as the price. Okay. Now, again, with Bollinger Bands, a lot of the time, a lot of people tend to fade Bollinger Bands when they move from the top extreme to the bottom extreme. But you will only be able to develop a strategy on this if you are using specific identifiers. So again, as an example, I would want to fade the Bollinger Bands only in the instance where, one, it's a specific time of day, plus we have relatively low volume. Okay, and you'll notice when we have this relatively low volume period between 5:40 and 7 p.m., okay, you will notice that at the same time the Bollinger Bands were at the tightest levels they were throughout the cash session, and we then rotated from the low Bollinger to the high Bollinger to low Bollinger to high Bollinger, a little bit of consolidation, and then the volume picked up and the trade no longer existed, or the pattern no longer existed. Okay, and so forth, guys. Another identifier can be range expansion. So we can see on these 5-minute candles, every time we have an expansion of the range, you get a certain pattern, which is when we have a nice big green candle, notice how price continues to move upward. Okay, again, when we have a big red candle, notice how price pressure maintains to the downside. Now, I'm not merely saying whenever you get a big green candle, you should be looking to buy. What I am saying is that that is a potential identifier that with other identifiers, you can learn to recognize various patterns. Okay, guys, what I want to just finish with regards to this is I just want to show you at no point did I try and apply a fundamental analysis to this. At no point did I say I'm bullish or bearish. I am merely trading the information or the patterns that the market is showing me. Now, the reason we have to do this as day traders, as swing traders, is because we cannot enforce our opinions on the market. We cannot become too subjective on the market, because at the end of the day, we're not speculative traders. We're not big influential players in the market. We merely have to look at the information that the market's providing us and execute and develop strategies accordingly. Okay, now what I'm going to do is As we go through this Periscope, I'm going to show you a unique strategy. I'm going to show you how to execute it based on objective information, so based on some of these identifiers.